how to save your house from loan default, the full story of the real rules behind 60 days, 90 days and bank auction. It is around 11:30 at night. A dim light is on in the drawing room of a middle-class family. Everyone is smiling in the family photo hanging on the wall, but a notice lying on the dining table of that same house has taken away the sleep of the entire family. The EMI had been stumbling for the last few months. Income had not remained that steady. And now the fear is that the very house for which years of earnings, savings, and sacrifices were invested might go into the bank's possession. This is where the story begins. The fear is this: when does a small slip in a home loan turn into a major crisis? And the curiosity is whether a bank can really auction the house after just a 60-day delay, or whether there is a long legal process behind it that is extremely important to understand. In India, a house is not just an asset. It is a symbol of dignity, stability, future, and emotional security. That is why millions of families take home loans to buy their homes. The logic behind taking a loan is also clear. Arranging a large lump sum amount is difficult, but payment through EMI seems manageable. Banks too consider the property as security and therefore lend at comparatively lower risk. But the real truth of a home loan is decided not by paperwork, but by repayment discipline. As long as the EMI keeps going on time, the house feels like your own. But the moment the repayment cycle breaks, that same house becomes a secured asset and turns into part of the bank's recovery system. First of all, clearly understand the claim that often circulates on social media, WhatsApp forwards, and half-complete news. If dues remain unpaid for 60 days, the bank will auction the house. This line is not entirely correct. According to RBI's prudential norms, a term loan, such as a home loan, is generally treated as an NPA when interest or installment of principal remains overdue for more than 90 days. That means being overdue for only 60 days does not automatically amount to the start of an auction. Generally, the account first goes into the NPA category, then a 60-day demand notice may be issued under Section 13(2) of the SARFAESI Act. After that, if the dues are still not cleared, the secured creditor can move toward actions like possession and sale. So the 60 days are part of the notice stage. But before that, the 90-day overdue element is very important. This legal distinction is the most important thing because many borrowers make mistakes in panic. They feel that one or two EMIs have been missed and now the house is gone. Whereas the reality is that default triggers a process, not instant seizure. But this also does not mean that the borrower should become carefree. In home loan default, the most dangerous thing is often the delay itself. First, a late fee is charged, then collection calls increase, the credit score gets affected, the account comes under stress, and if the overdue continues for too long, then the legal recovery framework can get activated. So the correct understanding is that 60 days may feel like a final warning, but before that, the borrower has time to recover. Only that time has to be used in the right way. Now the question comes, why does the bank give such a big loan in the first place? The answer is hidden in the loan to value or LTV ratio. According to RBI's housing finance norms, LTV caps are fixed for individual housing loans. In the loan category up to 20 lakh, up to 90% LTV is allowed, above 20 lakh and up to 75 lakh, 80%, and above 75 lakh, up to 75%. The meaning is clear. The bank generally does not finance the full 100% of the property value. It wants the borrower too to have skin in the game. The purpose of this structure is exactly this, that if property prices fall, the market becomes weak, or the borrower's income comes under pressure, then both lender and borrower should remain with some margin of safety. That means if a family is buying a property worth 50 lakh, the bank will not give the entire amount. The borrower will have to bring the down payment. At first glance, this feels like a burden, but this very cushion helps in times of trouble later. The combination of low down payment and high EMI may look attractive in the short term, but in the long term, it creates the greatest vulnerability. At the time of taking a home loan, people often look only at how much loan got approved, whereas the real question should be, if income falls for a few months, for how long will the EMI keep running comfortably? The most fragile moment of home buying is not the day of purchase, but the next 5 to 10 years, when job changes, illness, education cost, family responsibility, and interest rate changes all come together in life. Interest rate is the next big character in this story. From October 2nd, 2019, banks were given a framework to link certain floating rate retail loans, including housing loans, to an external benchmark, and repo linked products became popular. This allowed borrowers to receive the benefit of monetary policy transmission more quickly. According to current RBI data, the repo rate in April 2nd, 2026 is 5.25%. But a borrower's actual home loan rate is not just the repo rate. It also includes the lender's spread, credit profile, risk premium, and loan product structure. So it is not correct to assume that if the repo rate is low, every borrower's EMI will automatically become much lower. A floating rate loan can provide relief, and in the future, it can also increase EMI pressure. This is where many people make a subtle mistake. They become happy after seeing the sanction letter, but they do not read the loan agreement in detail. Whereas in a floating loan, reset clauses, spread, benchmark linkage, EMI change, tenor extension, late payment charges, insurance bundling, conversion fee, and other costs determine the future burden. In recent FAQs, RBI has also expected lenders to explain key facts, APR/KFS, and the impact of benchmark changes to borrowers. In other words, today the borrower has a greater right to ask for information, but the responsibility is just as great that before signing, he understands what kind of debt he is taking. For buyers of under construction property, there is one more special risk. RBI has clearly said that in incomplete or under construction projects, housing loan disbursal should remain linked to the stages of construction and should not happen upfront. In 80-20 or similar subvention type structures, the risk was that the bank would release a large amount to the builder very quickly, the project would get stuck, and in the end, the buyer alone would get trapped. That is why it is important for the borrower to understand that a bank loan being sanctioned and the money being released at the right stage are two different things. At the time of taking a home loan, not just the interest rate, but the disbursal structure is also part of property safety. Now, the real beginning of saving the house comes through repayment discipline. Finance experts have for years given a practical thumb rule that EMI should be kept at such a portion of monthly take-home income that it remains manageable even after other major expenses, emergencies, and rate hikes. Every family's situation is different, so there cannot be one single magic number. But one thing is certain, if EMI starts gripping your income too tightly, then the house becomes less of an asset and more of a pressure cooker. Before taking a loan, people should look at present affordability, not future increments. If salary increases, that is good, but even if it does not increase, the EMI should still run. It is this conservative planning that saves the house. Credit score also quietly plays a very big role in this whole story. A strong repayment history and a good credit profile can help with better pricing, smoother restructuring discussions, and lender confidence. On the other hand, continuously missed EMIs reduce the borrower's bargaining power. When the borrower remains regular, the lender sees him as a responsible customer. But when the account comes under stress, every next conversation becomes more difficult. So do not understand a home loan as just a monthly deduction. It is also a public record of your long-term financial credibility. That is why keeping the loan account healthy before a crisis comes is much easier than fighting later. There is one relief as well. RBI has directed that no foreclosure or prepayment penalty should be charged on floating rate term loans sanctioned to individual borrowers. This means that if extra cash comes to you, you receive a bonus. Want to repay some part by selling property, or want to make a partial prepayment, then in a floating rate loan, the route to reducing the debt burden is comparatively easier. This feature can become a lifesaver for many families. By paying a little extra principal every year, both the interest burden and the outstanding tenor are affected. That means the strategy to save the house begins not only after default, but much earlier through prepayment discipline as well. But a house is not saved only by EMI and interest rate. Insurance is also a big protective shield. In India, overall insurance penetration is still much lower than the global average. Industry and policy analyses show that India's total insurance penetration in 2025 remained around 3.7%, which indicates that the protection culture is still not very strong. For homeowners, this means that many families buy the asset but do not make proper cover planning for its financial risk. Home insurance can provide strong protection for property damage risks, and term insurance can provide strong protection to the family against the outstanding loan burden. In case of any unfortunate event, insurance planning can protect both the house and the family from debt shock. The physical condition of the house is also no less important. The marketability, resale value, and refinance attractiveness of a mortgage property also depend on its condition. If the house is poorly maintained, legal papers are unclear, society dues are pending, municipal issues remain unresolved, or the usable condition of the property has declined, then in a stress situation, both refinance and distress sale can become difficult. People often take property valuation seriously when taking a loan, but in the later years they forget upkeep. Whereas the truth is that the strength of a mortgage property lies not only in the registry, but also in its real market condition. A strong property gives strong negotiation. A weak property creates a weak position. Now let us return to the point that scares people the most. What should be done after a bank notice arrives? The very first thing, do not remain silent. Silence makes default worse. If income has temporarily fallen, a job has been lost, business is slow, or a medical emergency has come, then talking to the lender at an early stage can often make a big difference. Discussions on restructuring, revised repayment, temporary relief, tenure extension, or other lender-specific options are possible only when the borrower is reachable and cooperative. The biggest mistake in default is not that the EMI was missed. The biggest mistake is that the borrower starts avoiding bank calls, ignores notices, and leaves the problem to time. When the account becomes NPA and SARFAESI demand notice arrives, even then the borrower's rights do not end. A Section 13(2) notice gives the borrower a chance to clear the dues, and the law also recognizes the route of objection and representation. If the borrower feels that the amount is wrong, the charges are excessive, the procedure is flawed, or the facts are misrepresented, then giving a timely response is necessary. Legal advice can be very useful at this stage because recovery law is technical. But even at a practical level, the borrower should understand the notice, ask for an outstanding breakup, correct the records, and keep the doors of negotiation open. The chances of saving the house increase not by running in panic, but by understanding the process. The most practical lesson of this story is the emergency fund. The last few years have taught families in India that job loss, salary cuts, illness, business slowdown, or family crisis can come suddenly. That is why, for a borrower taking a home loan, an emergency cushion equal to 3 to 6 months of EMI is not a luxury, it is a necessity. This buffer can often become the strongest wall between a legal notice and normal recovery. If a few months of crisis can be handled without default, then the house remains safe, the credit score is protected, mental stress stays lower, and family stability does not break. The safety of a house lies not only in the registry and bank sanction, but also in your savings discipline.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.